Hello and welcome to a continuation of our discussion on deferred taxes. In this video, we will learn how to account for net operating losses and valuation allowances. We will also learn how to report deferred taxes on the balance sheet. After viewing this video, you will be able to record a carryback and a carry forward of a net operating loss. You will be able to explain and record a valuation allowance and state how the balance sheet reports deferred taxes. A net operating loss is a loss on the tax return, or for our purposes, in the tax column. Tax payable is zero when a company has negative taxable income. The IRS allows a company to use this loss to offset past income or to offset future income. An offset to income earned in the past 2 years is called a carryback. The IRS allows a company to request a refund on taxes paid in the previous 2 years up to the amount of the loss. In the case of a carryback, a refund is requested and a receivable is recorded. A negative tax expense is recorded as a tax benefit. A company may also offset future income if there is no prior year income or the tax rate is higher in future years. Paying lower taxes in the future is a deferred tax asset, and this account is used to record the future benefit. A company can elect to carry back or carry forward, or they can also carry back to the extent of prior income and then carry forward the rest. Let's look at an example of a company that has an NOL in 2012. The company had income in the prior 2 years and elects to carry back the NOL, which means offset prior income and request a refund of taxes previously paid. The loss of $150,000 in 2012 must first be used to offset 2010 income, and then if there is some left, it offsets 2011. $120,000 is used to offset the income in 2010, and $30,000 is left to offset 2011. Income of $190,000 from 2011 is still available to be offset by any 2013 loss. The company incurs a loss of $300,000 in 2013 and elects to carry back the $190,000 to take advantage of the higher tax rate in the future. The difference of $110,000 is a carry forward. The tax rules allow for a company to carry back 2 years and then carry forward for 20 years. The refund is received at the same tax rate that the taxes were previously paid. The 2010 amount of $120,000 is multiplied by the 2010 tax rate of 30% to determine the 2010 refund. The $30,000 offset in 2011 is multiplied by the 2011 tax rate of 40% to determine the refund amount. The 2 years added together are recorded to income and tax receivable. The IRS will send them a check. The reduction to tax expense is recorded in 2012. You do not go back and adjust prior year's tax expense. Now let's assume the company has an NOL of $300,000 for 2013. The company can go back 2 years to 2011 and offset any remaining income. Amounts from 2012 were previously carried back. The remaining income was $190,000. This leaves $110,000 to carry forward. The company will record a receivable for the carryback amount at the 2011 tax rate of 40% and will record a deferred tax asset for the carry forward at the future tax rate. A negative tax expense, referred to as a tax benefit, is recorded for 2013. In our class, we will use a 2-year limit for carryback and a 20-year limit for carry forwards. The number of years allowed changes every now and then when the tax law changes. 2 years and 20 years may or may not be the current tax law. Let's talk about valuation allowances and when a valuation allowance is necessary. A deferred tax asset reported on the balance sheet represents future benefit to the company. The future benefit occurs when less income taxes are paid. A valuation allowance is recorded to reduce the deferred tax asset when it is not probable that less income taxes can be paid. FASB defines not probable as more likely than not that the tax asset won't be realized. This determination is made at the end of each period. Paying less taxes is not possible when the company is incurring losses and no taxes are expected to be paid anyway. It is impossible for the company to pay less taxes than no taxes. A valuation allowance is generally required when the company is not expected to be profitable in the future. Prior year and current year losses with no expected improvement in the results of operations generally require a valuation allowance to reduce the deferred tax asset. A strong earnings history, sales expected to continue in the future, and deferred tax liabilities to offset deferred tax assets are generally signs that no allowance is needed. A reduction to the deferred tax asset is recorded as tax expense. An expense is recorded when an asset is used up. The valuation allowance is a contra account, and it increases with a credit. The valuation allowance is reported very similar to the allowance for bad debts. The deferred tax asset is recorded net of the allowance account on the balance sheet. Let's look at an example of how to record a valuation allowance. The company had a deferred tax balance of $120,000 in 2012 and $260,000 in 2013. At the end of each period, the company has to make a determination of how much of the deferred tax asset will be used for future benefit. At the end of 2012, the company determined it was more likely than not that 20% of the asset would give future benefit. This means that it is necessary to have a valuation allowance for 20% of the deferred tax balance of $120,000 or $24,000. At the end of 2013, the company determined that it was more likely than not that 60% of the asset would give future benefit. This means that it is necessary to have a valuation allowance for 60% of the deferred tax balance of $260,000 or $156,000. The company had a beginning balance of 0 in 2012, and it was determined that a $24,000 balance was necessary. The entry is recorded for the difference in the beginning balance and the computed ending balance. The contra account reduces the asset and an expense is recorded. The company will report a net deferred tax asset of $96,000 on the balance sheet. The company had a beginning balance of $24,000 in 2013, and it was determined that a $156,000 balance was necessary. The entry to record the difference in the beginning and the computed ending amount is $132,000. The contra account reduces the asset and an expense is recorded. Let's change subjects and talk about how you determine if a deferred tax account is current or non-current. All balance sheet accounts must be reported as current or non-current, and this includes deferred taxes. A company first classifies all book tax differences as a current or non-current difference. Current assets are netted with current liabilities, and non-current assets are netted with non-current liabilities. FASB determined that it is more important to report whether or not it was current or non-current than to show total assets separate from total liabilities. A company can have two assets or two liabilities, one that is current and one that is non-current. Here is a sample of book tax differences that are current and non-current. If the difference is associated with a current asset or liability, then the deferred tax from the difference is also current. If the difference is associated with a non-current asset or liability, then the deferred tax from the difference is also non-current. The company makes a list of all the differences and sets up two columns. Current is put in the current column and non-current is put in the non-current column. The amounts are then netted and the net is reported on the balance sheet. We will go over an example with numbers in class. After viewing this video, you should be able to record a carryback and a carry forward of a net operating loss. You should also be able to explain and record a valuation allowance. You will also be able to state how the balance sheet reports deferred tax. This concludes our discussion on deferred taxes. Please practice, practice, practice. Thank you for being prepared for class. It is much appreciated.